Welcome to the What to Watch video. Every week, I post a number of different videos. I do a video each day. I do a weekly video. Every week, I also do an intermarket analysis video, and also once a week, a thing called a deep dive video. And taken all together, that gives you a pretty good idea of what's happening in the market. Well, then I step back and I make this video where I'm just looking at those things that I'm really watching right now. This can change over a period of time. Sometimes it doesn't change very much at all. The things that we're watching right now were pretty much the same things we were watching a week ago with a few little adjustments along the way. So there will be times when I may post this video quite often. There are other times when you may only see this video once a week. And this is a shorter version of a video to give you an idea of what I'm really watching. But to get the context, I would really recommend that you follow at least the daily video. And this is being prepared for Monday, February 26th. The first area that I look at are those things that are positive. First thing is, the markets are anticipating that rate cuts, when they do finally happen, will be slow. Now, there's other times when the Fed has had to come in and cut rates because something bad has really happened, like 9/11 or the great financial crisis or the COVID lockdowns. Well, right now, the market is anticipating when the Fed comes in and finally starts cutting rates, if that ends up even happening, that it's going to be slow over a period of time. And that tends to be more positive because it's adjusting to what's happening in the economy and can help companies grow rather than reacting to some really bad event that has happened. Another thing is that in Friday's session, the S&P did set another new all-time high. That's always a positive thing. We've never been in this territory before. The technicals that we look at, meaning all the charts that we follow, they remain positive, but we're looking overextended to the upside, and you could even make a case for being overbought. That's in the short, intermediate, and long term. Now, in a positive environment, we can remain overbought for lengthy periods of time, though. We're also keeping an eye on growth to value ratios. When the market's really doing well, growth outperforms value. When the market's running into some problems, value outperforms growth. They're holding up for right now where growth is still outperforming value, but it's not looking as great as it was a week ago. Also, we keep an eye on discretionary, which are the things that make life fun, versus staples, the things that you have to have. And typically when discretionary is doing better, that tends to be more positive for the market. It's holding up right now, but it's also not looking all that great. The S&P is in a solid uptrend, and I'll show you a chart of that. We did have a change. The parabolic SAR, which in my opinion is one of the more important intermediate term indicators that I use, it switched to negative a week ago. Now with the solid up week that we had, it's now switched back to positive. So that is a positive sign as well. The NASDAQ is close to its all-time high. It's not quite there yet, but it's getting close. And the Japanese Nikkei, that's their big index over in Japan. The Bank of America had been predicting that we were going to surpass the 1989 highs. Well, we did that this past week. This doesn't have to do with the US market so much, but hey, when the world's doing better, sometimes the US is doing better at the same time. Then there's an ETF called a total US stock, which has 2,651 stocks in it. It is setting a new all-time high, and there's a reason why I bring that up, and I'll show you that here in a moment. This is a chart that was initially brought to my attention by Chris Shavako, who puts out a video each week from Shavako Capital. I have a link to that channel on my suggested channels on my YouTube page. If you want to go check that out, he takes a longer term look at the market than usually what I do. He showed this in his video. I went to Twitter. I found this chart. I wanted to show it to you. This shows when the Fed is cutting rates, if they're cutting rates really fast, we see the green and the orange lines here where the market tends to have some problems. Well, when the Fed is cutting rates in a slower pace, which is that's what the market's anticipating right now, the stock market tends to perform better. And you can see all the data in this chart to go and back that up. So that's what the market is looking at right now. Now, this could always change. Something could happen, some kind of bad thing. And use your imagination as to what that could be, because we're living in pretty interesting times right now. But this is what it's looking like at this moment. But be aware that it can change. Another thing that is looking okay, but not great, this is a 10-minute intraday chart of growth versus value. The blue line is growth, and we want to see that outperforming the red line, which is value. And it had been doing that. It had been showing some improvement, but over the last couple of trading sessions, it's been starting to underperform. They were both up in Friday's session, but the red line is still above the blue line. We just want to keep an eye on this. This is just looking intraday as the market unfolds each day. And we also look at a 10-minute intraday chart of the growth to value ratio for the S&P. This had been showing signs of weakening, and then it really shot up, but now it's starting to fall back and not looking all that great as well. Even though we're setting all-time highs with the S&P, we haven't surpassed the highs set earlier in February. We want to really see this ratio going up to be more positive with the market. But for right now, it's hanging in there. Then we also look at an end-of-day chart comparing small cap growth to small cap value. This had really been improving, but lately has been falling back. The small caps themselves have pretty much been chopping sideways, and that's been really disappointing to a lot of folks who were really expecting that big January effect. Well, this was the December effect, and once we got into January, we've been chopping around and going sideways ever since. We also keep an eye on mid caps with an end-of-day chart comparing growth to value. This is looking a little stronger, but again, we're starting to break out here when we look at the index, but we're not breaking out when we look at the growth to value ratio. This is still positive, but it would be even more positive if we saw growth doing better. Then this is the one that I look at the most. This is S&P growth to value on an end-of-day chart. And again, we're setting all-time highs with the S&P, but we're not even really breaking out here with the growth to value ratio. Last fall and into October, when we were starting to go back up, we saw a big negative divergence here, and that stalled the market for quite a while. Then when growth finally kicked into gear, that really gave the S&P a lot of support to go higher, and then ultimately set an all-time high. So we want to watch this. This could be turning back positive. We're seeing a potential golden cross with this ratio if the blue line crosses above the red line. And we're also watching discretionary versus staples. What I follow mostly is the ratio on the bottom. Again, we're setting all-time highs with the S&P, but we're not even breaking out above previous highs with discretionary. It's going up, and that's positive, and it's hanging in there for right now, and it's not declining, but we want to see this doing even better than it's been doing lately. Then this is the trend line that I referred to, where it looked like we lost this, and we lost this earlier in the week. We've been going up from the October low to these other lows here. Well, this had been providing some support for the market. Well, we fell below that, but then we were able to shoot back up above that and actually get above this level. So that's looking better for right now. Then the parabolic SAR. This had turned negative with the dots on top. Now it's switching back and looking more positive with the dots underneath. Then we're looking at the NASDAQ, where we're not quite there yet to the previous all-time high, but we're getting close. Is this going to be positive where we break through and set a new all-time high? Or is this going to provide some kind of overhead resistance where we top out here and then see a decline after that? And then on top, we see where the S&P is setting all-time highs. Then we have the Japanese Nikkei index, where we're not much above it, but we are surpassing the high set way back in 1989. Then this is a total US stock ETF. Now, one of the scenarios that's being presented, and it's true, but we need to look a little deeper into this, is that there's 7 stocks, the mega caps, the Magnificent Seven, that are pretty much leading the market higher. And that's true. And they have more of an impact on the S&P 500, which is a weighted index. So when the big companies like NVIDIA, Microsoft, Meta, and so forth, when they do well, that helps the S&P 500. Well, there's also a case to be made that the broad market is doing okay right now. This is a total US stock ETF with 2,651 stocks, and this is breaking out and setting new all-time highs. So the idea that it's only the mega caps that are bringing the market up, that's true, but there's also other stocks in the broader market that are also contributing to this upward movement. Now we look at some negative things that we just want to be aware of. And these may turn into actionable things that help you make decisions, or they're just things that we want to know about and be aware of in case things keep going to the upside. The S&P 500 is below long-term resistance, and I've been really trying to point this out. I didn't mention this a week ago in this video because I didn't think it was going to become an issue. Well, it became an issue this past week, and I'll show you a chart of that. Sentiment is extreme positive. We've got a lot of folks that are really optimistic about the stock market right now. When a lot of folks get really positive on things, that's about the time when we want to look at leaving the party. We also have a thing called the equity put call ratio, and the one that we look at is based on 5 periods. When that's going down, that's positive for the market. When it's going up, that's negative. Well, it's still continuing to go up. Then we have a number of different studies based on 200 periods and 50 periods. These are negatively diverging from the S&P. I also have an additional one based on 20 periods that I'll show you. The transports are negatively diverging from not only the Dow, but the S&P 500. In a good, solid environment, we want to see the transports doing well, and they're not doing that. The small caps are really having a lot of problems right now. Again, in a more positive environment, we want to see the small caps doing better than they've been doing. The dollar has been going up since the beginning of 2024. That quite often pressures stocks. The stock market likes a weaker dollar for conversion rates and for import-export reasons. With it going up, that can put pressure on stocks. We're also looking at another ratio between the NASDAQ 100, which are growth stocks, and the Dow, which are the bluest of the blue chip stocks, the stocks that have stood the test of time. And this ratio is hitting all-time highs. There's some folks that are really latching onto this, more the perma-bear types, and they're basing a whole scenario that this upward move is finished now, and we're going to go in the toilet going forward from here. And that may happen, but let me show you that chart, and then I'll explain what we're watching for. Then there are negative divergences with the moving averages that we're seeing. And then we're coming into a period of time where we see weak historical seasonality. And I'll have some charts to show you that as well. The first one, this is longer term resistance. What you see here is a weekly chart of the S&P. These lines that you see here are called pivot points, and they're recalculated each month. So the cool thing about this is these lines are on the charts before we even get there based on time or price. So this line was here for quite a while now. And you notice how we came right up to this R1 line? That was the high in Friday's session. We could not get above that. The market tried a couple of times to break through that, and it's at about 51.11. And that was the high for Friday's session. Now, does that really matter? Well, take a look at this. Back in late 2021, we hit this pivot point, and that was the high. We ended up spending 2022 being under a lot of pressure with stocks, okay? Then we started to bounce back up in 2023. Last summer in July, we hit another one of these pivot points, and then we spent the next couple of months going down. So we don't know if we're going to be able to break on through to the other side, like Jim Morrison would say, or if this is going to provide overhead resistance. Right now, it's providing resistance because we hit that level a couple of times and then started to come back down. To me, this is an important thing to watch for the time being. Then we're also looking at sentiment. We're above that 75 level. Now, it could go higher than where it's at right now. It's gone higher before, but you notice when we get to really high readings like this, it may last a while, but eventually it starts to turn and come down. And usually when this is going down, stocks are going down as well. This is another sentiment gauge that's updated once a week. The last one was updated on February 20th. This is Investors Intelligence, and we're above this 3 level, which means we're also looking pretty extreme as far as sentiment is concerned, but we could still go higher than what we're seeing right now. Then we're also watching the equity put call ratio based on 5 periods. When this is going down, that tends to give support to stocks. Well, this is continuing to go up, and that's causing us a little bit of a concern. Then we're also watching a correlation between the VIX and the S&P. And I did show this a week ago because this really hasn't been dealt with yet. We're getting an extreme reading. We go up, then we come down, then we go back up. Okay, so what does that mean when we get a high reading like this and then finally spike at the top and come down? Well, look at other times that I marked here, and that typically was negative for the market. Now, there are some exceptions to that, and this could be a different time. We just want to be aware of this. If this ratio really starts coming down as stocks are going down, that's what the market may be anticipating. And we also look at some negative divergences here. This is the S&P 500 McClellan oscillator, where the S&P has been going up, but the McClellan oscillator, even though it's positive and above zero, it's still negatively diverging. We would want to see this giving us really high readings that it's not doing. Then a longer term look is the summation index based on price, where it's positive, it's going up, but it was going down as the S&P was going up. That's when we look at it based on price. It's been going down and then chopping sideways based on volume. So both of these are negatively diverging from price. Then we look at a broader market measure here, the NYSE McClellan oscillator, where it's above zero and advancing, but we're also seeing that negative divergence when we compare it to the S&P. We're also seeing that negative divergence with the summation index based on price and volume when we compare it to the S&P. These are things that cause us concern. Then this is another concern that we have where the Dow is close and setting new all-time highs where the transports are not. It's having a really difficult time just breaking out above previous highs. I'm not really following the utilities right now. They're in a longer-term downtrend. This is a chart just of the transports where it looked like we were breaking out above this high set in late 2023, but then we came back down below it. Now we are bouncing back up, but we've got a long ways to go to get to this previous high set earlier in 2023, and the all-time high was set near the end of 2021. If the transports could really get some steam going, there's a joke in there somewhere, and really start to go up, that would confirm what we're seeing with the Dow. That would be a Dow theory confirmation. Until that happens, we're seeing that as a Dow theory non-confirmation. Then we're looking at a ratio between the transports and the S&P. When this is going up, the transports are outperforming. Well, we've been going down quite a bit now. And in a good solid environment, we want to see this ratio going up. And that's not been what's happening. And we look at the small caps, which are continuing to underperform the S&P 500. They did really well at the end of 2023. Once the clock ticked over and we started 2024, it's been really underperforming. The dollar has also been bouncing back up since the beginning of 2024, which could pressure stocks. And then we're looking at 20-period moving averages in the S&P 500 compared to the S&P itself. We are seeing a negative divergence. Now, this is improving, and it could show some more improvement along the way, but right now it's still showing us a negative divergence. We're also seeing that when we look at the 200-period moving average study, it's improving, but not coming back to these previous highs. We're seeing the same thing with the 50-period moving average study. So we're seeing it across the 20, 50, and 200. This is short, intermediate, and long term. Then this is one that, and I actually got the idea for this chart a while ago based on a perma-bear video that I watched. And they're building a whole scenario based on this. And it may end up turning out, but it may not turn out this way either. My problem with this is when you use one chart to come to one conclusion that's based on a small detail of a very complicated and very big stock market. I think you need to use a lot of charts to come to a conclusion, not just base everything around one chart. I could be wrong, but I've been right for decades now when I've used this approach. Now, what this measures is the NASDAQ 100 against the Dow. The NASDAQ 100 are growth stocks. The Dow are more blue chip established companies. We saw this really going up into the dot-com boom. It finally topped out, and then we saw the dot-com bust. And it took many, many years for it to finally claw its way back. And then we hit this previous high again in late 2021. Okay, so you can kind of see the logic going on here. Then we fell after that. This was the difficult year that we saw in 2022. We're coming back up to that level again now. Now, could this lead to something negative? Of course. But we also want to follow other things to reach our conclusions. But for right now, we just want to be aware that this is actually happening. Then looking at seasonality, this is put out by Carson, and this is showing, we see a little bump up along the way here, but for the most part, February from now until the end of the month tends to be negative seasonally. This is a longer term chart. Here we're highlighting February into March, where a lot of times we see weak seasonality going into the mid to latter part of March, and then gains that we see during an election year, that typically happens after that. We're also seeing that here. This is a green line when the current president is running for re-election, and we do see some weakness with the green line going into the latter part of March before we see strength after that. Now, we don't know if it's going to play out exactly like this, but when you go from 1949 to 2023, that's the way it has played out. So sometimes history has a tendency not to repeat itself tick for tick, but sometimes it can rhyme. Then Tom Bowley also has some research, and for the rest of the month of February, based on what he's done for the S&P, we tend to have negative returns going forth. Thank you. I really hope you found this helpful. Please feel free to check out my other videos. I hope you have a really good week, and I will talk to you in the next video.